In this presentation, we will enter an adjusting entry related to loans payable. We will break out the short-term and long-term portions of one loan and take a look at how multiple loans can be grouped into one loan payable account and how we adjust for that when thinking about interest and the short-term and long-term portion of loans. We will do this within QuickBooks Pro 2019. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are on the home page. We currently have the open windows open. You can open the open windows by going to the View drop-down and selecting the Open Windows list. We're first going to take a look at the financial statements and look at the loans. Our objective now is to enter adjusting entries. Now, the adjusting entries are things that happen at the end of the time period. Small companies may not be doing all of the adjusting entries and may rely on, say, a CPA or tax preparer at the end of the year to make some of the adjusting entries. And these are also entries that we may want to plan into the system to have adjustments from a CPA firm or a bookkeeper. In other words, we might want to set up our system if we want to do the bookkeeping and keep the bookkeeping separate in such a way that we can enter the books as easily as possible and plan for some of these adjustments to happen on a periodic basis, either monthly or yearly, to make the financials correct at any kind of reporting time when we have to report to others or to ourselves to have them as accurate as possible on an accrual basis. Now, these adjusting entries are something that we usually have to do some kind of journal entries for. So it's useful to us to know debits and credits to do these types of adjusting entries. It usually takes a little bit more accrual accounting knowledge to do the adjusting entries. So it's possible to do bookkeeping without really doing the adjusting entry process, just entering the data and working with, say, a CPA firm or an accountant to then go in and make those adjustments on a periodic basis. That's one system that's often a useful one. So what we're going to do is go to the reports up top, and we're going to go to company and financial, and we are going to go first to the balance sheet. So we'll take a look at the balance sheet. We're going to make the date range up top in the custom report, and we'll change the dates from 01/01/19 to 12, let's make it 02/28/19. So we're going to make these adjusting entries, and our financial statements are going to be as of the end of February. So our cutoff date then is February. So the balance sheet, of course, is the end date there. We put two dates so that if we double click on something, we will have the range as we do so. What we're going to do first is look at the loan down here. We got this loan payable here. The loans, there's often something we're going to have to make adjustments for, possibly because we have interest that hasn't been recorded, or because we have a short-term and long-term portion, which is really what we're looking at here. Now, the loans can be reported in a few different ways. We may group the loan, all the loan. We might have more than one loan. We might have equipment out there that we financed. We might have some other types of loans. We might have taken a bank loan out and whatnot. And we may just group those into one account called loan payable, and then have the supporting documentation for those loans in amortization tables to support this loan payment. Now, we also could have loans that are short-term and long-term in nature, and short-term liabilities or current liabilities simply mean that they're going to be due within a year. So if the loan is going to be due within a year, then we're going to want to break it out to a current liability for reporting purposes. And if it's due over a year, then it's going to be long-term. And that's useful for reporting because it helps us to manage cash flow. It says, okay, do I have to pay this pretty soon? We're going to need the cash in order to do so, to pay it pretty soon. So when we display reports, we want to see that. It presents a problem, however, when we're entering data because for an installment loan, that current portion versus long-term portion changes every time we make a payment. And so for us to do that as we go, as we make payments, is more tedious, probably more work than it's useful for. So for that reason, there's a couple different ways you can do the bookkeeping and then do the adjustments. It's possible to want to do the adjustments just at the end of the time period. We might say, hey, here's all of our loans are grouped up in this one account, so it looks nice if we were going to provide it to somebody. And then we're going to adjust it at the end of the time period, breaking out the current and long-term portion. and then possibly reverse that entry, putting it back into one account so that we can track it more easily in this way. Another way we can do it is possibly have the loan payable here and have a sub account of all our different loans. If we have multiple loans here, we can have a sub account, and so that way we can have the detail on this statement and be able to condense it. However, we're still going to have to break out the short-term and long-term portion if we do that, and it's probably not the case that we want to make 2 accounts per loan that we actually track as we make payments, because that becomes tedious. So this is something we basically adjust on a periodic basis as we do financial statements, either monthly or yearly. If we double click or zoom in on this loan, we'll see that we had a loan prior to this. This is when we started the company at 22. That's when our beginning balance loan, then a 50,000, and we're going to say that this 72 is actually one loan. So we reorganized this one loan at 72. We made these 2 payments on a loan. Those are going to be on this 72. And then we took out another loan for this 5,000. So there's actually 2 loans that are in this loan payable. One's for 72 after we updated and financed it and has been paid down to this 69,878, and the other is for this 5,000. We here are going to be dealing with this 5,000 one first. And so to do that, first we want to take a look at the backup detail of it, and that's typically going to be an amortization table. So we're going to say, okay, the loans, whenever we have a loan, we're going to have to say, let's take a look at the amortization table and see if it's short-term or long-term. Now, if we look at the loan terms, we might not see the amortization table because they may only give us for the balance, the loan amount, the periods that will be covered. We're going to have, it's only 6 months, the rate, and then this is going to be the future value. And I'll show you just basically how to calculate this future value. So we'll calculate that future value. So in other words, this is the loan we're going to have, and this is a little bit different than the loans we might be used to in that we're not paying installments. And the reason we want to be careful of a loan like this is because that means that we're not making interest is accumulated. We borrowed 5,000 and we're going to have to pay back more than 5,000. And we may then have to account for that by doing an adjusting entry for the amount of interest that we will be paying in the future that has accrued that we have not yet paid. So we could put this information into a worksheet like this and look at, say, the amortization table to see how much interest accrues for each time period. So it's useful to do that. One, we'll take a look at the future value here. The future value is going to tell us how much we're actually going to pay within this loan, what it's going to be worth within the future. So the present value then is 5,000. That's how much we're borrowing. And then we're going to get the future value. So to do that, we'll use the Excel formula here. We're going to say equals, and then I'm going to put in FV, future value, double click on that, and then we'll get this little bar down here which will tell us how to calculate this. So this will just give us an idea. If you see a loan like this, then we can calculate what the future value is, and then we can use a little amortization table to see how much interest we would be paying or would be accruing in each time period. So we're going to say here that the rate is the 6%. That's for a year, however. If we divide that by 12, this would be the monthly rate. And then we're going to say comma, that's what's going to divide these two items. So I'm going to say comma, and then it says we want the number of, this is periods, the number of periods, which is 6 months, not 6 years, 6 months. So, and if it was 6 years here, we can break it down to months. We need to make sure that this rate aligns with the number of periods we have. So in this case, there's 6 months, and we need to align that with the rate. So the rate is this yearly rate divided by 12, giving us the monthly rate. So then we're going to say comma, and the present, or the PV or present value is going to be the 5,000. That's what it is as of today, today's date. And then comma, and then we are going to have the, I'm sorry, this is the PV. This last one was the payment. Now this one's a little bit tricky because if it was an installment payment, we would give the payments that we are making each month. But it is not an installment payment, so we're not paying each month. We're going to pay the entire amount back plus the interest at the end of the loan. So this is another kind of business loan. It's fairly standard to have a business loan like this, little different than the loans we probably normally see, and therefore we can either put another comma or a zero because there is no payments we're going to make. We just want to know what the value will be in the future with no payment. So how much we're going to have to pay back at the end of the loan term. So then we're going to say comma, and that now the present value is going to be that 5,000. And then I'm going to say shift 0 and close that up and enter. So in other words, this future value then is 5,152. So that tells us kind of how much interest or the value is in the future. And therefore, if I want to make this a positive number, I double click on it. I'm just going to put a negative before the FV. That's one way to do it. And that'll flip the sign. So that helps us, but it doesn't tell us how much interest is accumulating each time. So to do this, we're going to do a little amortization table. It looks a little bit different than if it's an installment agreement. We're just going to say 1, 2, 3, 4, 5, 6 periods. The payment is always going to be basically 0. We're not making a payment. But I want to keep the payment there so we can format it the same way we would with a normal kind of installment agreement. You can have these same kind of headers that you would see here. This should be principal. So there we have that. So the payments are always going to, so I'm going to say equals that 0, and that's going to be the same. So I'm going to autofill that all the way down. The interest, if we were to put this into a calculator for one period, 1 month, is going to be the 5,000 times 6%, 0.06. That would be for a year divided by 12. So it'll be 25. So let's do that calculation here. It's going to be, interest is going to be equal to that 5,000 times the 6%, and then we'll take that and divide it by 12. So that'll be the interest. Now the reduction in principal is going to be, it's going to increase the principal here because the interest is going to be increasing the principal, which of course will just be the 25 because there's no payment. So I'm just keeping the same kind of headers we would see. This is going to be increasing the principal then, how much we owe back at the end. And so we can say the net value or how much we owe back. This is actually interest over and above the principal. But this is the value of the loan at this point, principal plus interest. Probably be a better name, principal plus interest. But we're going to say this equals the 5,000 plus the 25. So if it was after 1 month, now we're at 5,000 plus 25, or the 25 is now the accrued interest over and above the loan that we would owe. So if we do this again, of course, the interest is going to be the same for month 2. And what we're going to say here is that this is going to compound. The interest is going to compound monthly. So that means that if we're in month 2, then we're going to say the interest is going to be equal to this balance, the principal balance, that plus the 25 there, times the 6%, and then divided by 12. So it's still 25, but if we were to add decimals, it's actually 25 and 13 cents. So I'm going to take the decimals array. It's around 25. And then we're going to say the balance increase. I changed the name to balance increase is going to be the 25. And then this number is going to be this prior balance plus that increase. So this will repeat as we go down, and this number will go up slightly as the principal balance goes up. I'm going to try to copy it down now. So we'll highlight these and copy it down one time. And notice it doesn't do what we want, and that's because if I double click on this guy, this one pulled down. This is B3. I want to keep it at B3 and it pulled down. So what I'm going to do is delete that and delete this, and I'm going to fix this one. I don't want this cell to pull down. I want this to pull down when we copy it, but not this one. So this is cell B3. I'm going to put my cursor in B3 and select F4 on the keyboard. And what that does, and you could just type in if you want, just a $sign before the B, a $sign before the 3, making it an absolute reference. So that just tells Excel, do not copy that cell down. Don't have a relative reference. Keep that cell as you copy the formula down. So enter. Then we'll highlight these again, put our cursor on the autofill, and take that down, and there we have it. So note that the interest is going up slightly to around 26. So if we add the pennies, it's going up a little bit. And we end up with the principal and interest equaling our fair value that we have calculated here. So this is just one format that a loan could be set up as. And if it was so, then we would need to know how much of the interest is being accumulated in each time period. So in this case, we have around 25 each time. So the point of this is it's going to show us now that this interest amount, if we're at the end of the first payment, then this interest amount had accrued, but it had not yet been paid, and therefore we're going to need an adjustment for that. And it also shows that at this point in time, the loan principal is still going to be the $5,000, but we have the accrued interest over and above that. So the principal is still $5,000, and it will be due within the 12-month time period. So we're going to put the principal into the current portion, and we're going to have to make an adjusting entry for the interest that has accrued for which we have not yet paid it. So those are going to be two adjusting entries we will have based on this table. First one, we're just going to say, well, the principal balance is still the $5,000, and we're going to move that from the long term to the current because it, of course, is due within a 12-month time period, it being only a 6-month loan here. So let's go back to QuickBooks. In order to do that, we're going to make an adjustment, and we're going to move this out of the long-term portion and put it into a current loan payable. Traditionally, the way you really want to do this is to go to a journal entry. And so if you went to a journal entry, we would go to the company up top, and we would go to make journal entry. And we would have debits and credits here. We would make all adjusting journal entries as of the end of the month, and the adjusting journal entry would then be a debit to the long-term loan payable, decreasing it, and a credit to a new loan payable we will set up with this loan payable current portion, the current portion loan payable, which would be a current liability instead of a long-term liability. In order to do that, however, we would need to know the debits and credits. And if we don't know the debits and credits and we still want to do the adjusting entry without them, then we could try to use registers. And I'll do that for a few of the adjusting entries, and the ones that are longer than basically 2 journal entries will then go into the actual journal entries, which would be the preferred method to do. But we'll also go back here and see what happens in terms of debits and credits, so we can see both methods. So I'm going to close this back out. Now, if we want to try to enter something without a journal entry and adjust this, I know what has to happen here. This loan payable account needs to go down. So what we're going to do is go to the register. We could go there by going to banking, use register, and change it from the checking account to a liability, which is the loan payable liability account right here. The other way you can get into there, which is to go to lists, chart of accounts, and then we're going to look for that loan payable right here. There it is, and just double click on that item, and it'll give us that register format looking much like the bank register. So then what we're going to do is we're going to make this as of the end of the month, 2/28. I'm not going to put any reference. There's not going to be a check number or anything like that. There's no real payee. This is an adjusting entry that we're going to have. And we know that this one needs to go down. I may not know if it needs to be debited or credited, but I know that the balance needs to decrease by $5,000 because it needs to go out of the current portion and into the long-term portion. Now, there is no loan payable for long-term note payable. We don't have one here. If I scroll up, there is no liability. We should have a current liability is what we're looking for a loan payable. So other current liability, we don't see one. So we're going to type in new liability. We're going to call it a loan payable, and we could say current portion or something like that, and then tab. We're going to set up that account, and it's going to be not an expense. That's the default. We're going to say no, that's not what we want. We want it to be an other current liability type account, other current liability. Then we don't need any subcategory, nothing else here. Nothing else is needed here. We're going to say save and close, and then it's going to create a journal entry, see? So it still creates a journal entry for us. And then we might just want to put here that it's an adjusting entry, which I might abbreviate as ADJ, and to break out short-term portion of loan or something like that, and say okay. Make sure it's recorded, and then you can see the debit and credit by double-clicking on this and say, okay, what did it do in terms of debits and credits? It had a debit to the loan payable long-term and a credit to the current portion. And so if you want to think through the debits and credits, that'll be there. I'm going to copy this memo and put it there as well, and then save and close. So now I'm going to close this back out, and we'll close this back out, close this back out. And if we go to our financials, then we should have the updated information. Here's the loan payable 74, and it's not there. Why isn't it there? Because I entered a date thing again, so I put the date in there as of 21. Another problem I've been working on. If I increase the date, I see the transaction here. So clearly, so 2 years off there, you know. So we're going to have to adjust that. So I'm going to double click on this item. And oftentimes if you don't see something and you're doing these adjusting entries, it's usually a date thing. And you can guard against that by having default filters that tell you, give you a pop-up, say, hey, you know, that's 2 years out. And so maybe you don't want to, maybe that's not correct. And that could help you to not do that in practice. We've turned those off here, of course, because we're working in a different time frame. So we'll double click on this item, and I'm going to change the date on this to 2019 and enter, and then we'll close this back up. So there, now we see it here. If I close this back up as of the date of 2/28, we see that this has been decreased now to the 69,878, and in the current portion now we have the 5,000. So this is useful to us because we can say, okay, this is what is actually owed soon. And you might say, hey, there's more than that owed. If I look at this here, we're going to owe that plus we're going to owe 5,152. Why don't I put that in the current portion? And the reason is because this interest hasn't been incurred yet. That would be the same thing as saying that we rent a building out and we know that we're going to be paying $12,000 rent next year in the building because we already signed the contract, and putting it in as a liability today. We don't do that because we haven't used the building. We haven't incurred the rent. We haven't used it. We haven't incurred it. Even though we've signed a contract saying we're going to do it, we haven't used the building yet. So it's not a liability until we've actually used the building. And the same thing is true here. It's not really an expense here or a liability to us until we've used the purchasing power of this 5,000. So although we know we're in a cash flow basis, we're going to pay 5,152 in the future, we're not going to put that as a liability today because the 152 is not something that we have currently consumed. However, we're going to say that we have consumed this first 25, and we will do an adjusting entry to record that, not posting it to the loan payable, but to accrued interest, a liability, current liability. And we'll see that in a future adjusting journal entry. For more accounting information and accounting courses, visit our website at accountinginstruction.info.